every single year your car insurance company sends you a letter, or an email, or a text, and in that communication is a number, your renewal premium, and that number is almost always higher than what you paid 12 months ago. And here is what most British drivers do with that number. Nothing. They accept it. They let the policy roll over. They pay the direct debit. They go back to their lives. In 2023, the average British driver was paying £627 a year for car insurance. Not because the roads suddenly became more dangerous, not because they had made a claim, not because their car had changed, because the industry had worked out with extraordinary precision that most people will not fight back. They will not switch. They will not even question it. That is not bad luck. That is the business model. And today, we are going to take it apart piece by piece. Why car insurance in the UK is not the same conversation as anywhere else in Europe. This is a different problem. Here is the first thing you need to understand. British drivers pay significantly more for car insurance than most of their European counterparts, and the gap is not explained by our roads being uniquely dangerous or our cars being uniquely expensive to repair. It is explained by a market structure built over decades that extracts maximum revenue from people who have no legal alternative but to buy the product. Market structure matters. Car insurance is not optional in the United Kingdom. The Road Traffic Act 1988 requires every driver on a public road to hold at minimum a third-party policy. That legal obligation removes your most powerful negotiating tool, the ability to simply not buy. The industry knows this. It has always known this, and the pricing reflects it. Compulsory. Take Europe. In May 2023, UK motor insurance inflation hit 43%. In Germany, that same month it was 2.6%. In France, it was 0.4%. In Spain, it was 0%. Same continent, same cars, same roads. The UK was not facing a global problem. It was facing a British one. The second thing you need to understand is what happened between 2021 and 2024. In 2021, during the pandemic, premiums fell to a 5-year low because nobody was driving. The average comprehensive policy hit around £430. And then, as driving returned, the industry did not gently bring prices back to normal. It ran them. By the fourth quarter of 2023, the average UK motor premium had reached £627, a rise of more than 34% in a single year. In some datasets, the rise was higher. Consumer Intelligence tracked a 61% increase between August 2022 and August 2023. The Association of British Insurers pointed to legitimate cost pressures. Vehicle repair costs had surged. The cost of paint was up 16%. Spare parts were up 11%. Energy costs at Tavours or some garages were up 300%. Modern cars packed with sensors and cameras and integrated electronics cost far more to repair than their predecessors. An average accidental damage claim reached £3,699 in early 2026. These are real numbers, but here is what the ABI does not put in its press releases. In 2024, the year after they told you premiums had to rise because the industry was losing money, UK motor insurers had their most profitable year on a record. They reported a net combined ratio of 97%. That means for every pound they collected in premiums, they paid out 97 pence in claims and operating costs. Record profits. While British drivers were still paying premiums inflated by the 2023 crisis, the crisis passed and the prices did not come down at the same speed. Third, the postcode situation. Your premium can go up because other people with the same car as you crashed more. Not you. Them. You did nothing wrong and you're paying for it anyway. Insurers do not price you as an individual. They price you as a category. Your postcode is a risk shortcut. If your postcode has a high claims history, your premium reflects that history regardless of your personal driving record. two identical drivers, identical cars, identical no-claims bonuses, different postcodes, different premiums, sometimes dramatically different. Inner London drivers pay an average of £798. South West England drivers pay an average of £471. Same country, same legal minimum, £327 difference. Not because one driver is worse because of the street they park on, that is not a bug. That is the model. How this video was built. I want to be clear about where this information comes from, because a lot of content you will find about car insurance is produced with commission incentives from comparison sites that make money every time you click through and buy a policy. This script is built on 4 things. First, the Association of British Insurers Motor Premium Tracker, the most comprehensive pricing dataset in the UK, based on actual prices paid rather than quotes, covering close to 28 million policies per year. Second, Financial Conduct Authority regulatory data and enforcement records. The FCA is the body that tried to fix the loyalty penalty in 2022. They are also the body conducting compliance audits in 2026 to check whether insurers are actually following the rules. Third, money-saving expert and money supermarket quote data, covering over 1 million real UK car insurance comparisons between late 2025 and early 2026. Real quotes, real prices, real savings. Fourth, Financial Ombudsman Service case records, which are publicly available and reveal exactly how insurers behave when customers push back. No insurer paid for placement in this video. Several of them would, I suspect, prefer this information stayed buried inside documents that most people will never read. To understand the scam, you have to understand what the rules actually say and what they do not. In January 2022, the Financial Conduct Authority banned a practice called price walking. Price walking was when insurers charge loyal, renewing customers significantly more than new customers for identical cover. Before the ban, Citizens Advice found that loyal customers were paying an average of £285 more per year than a new customer on the same policy. The FCA estimated this practice was costing British consumers £4.2 billion over 10 years. The ban came into force. Insurers were required to charge renewing customers no more than an equivalent new customer would pay. This is where it gets complicated. The ban did not stop premiums from rising. It stopped one specific mechanism for raising them. The industry, which employs some of the most sophisticated actuarial talent in financial services, immediately found others. The rules say your renewal price cannot be higher than the price they would charge a new customer with your exact same risk profile. But your risk profile can be repriced every single year based on changes in the local claims data for your postcode, changes in the insurance group rating for your car model, changes in the overall market cost of claims, and the expiry of any introductory discount that brought you in as a new customer in the first place. So your premium can rise every year without technically breaching the ban, because the base price for your risk category has been raised. The loyalty penalty has been banned. The loyalty problem has not been solved. The windscreen situation and why it costs more than the repair. A stone chip came off a lorry on the A14. It was not your fault. You were not speeding. You were not distracted. You did everything correctly. You claimed on your windscreen cover, the cover you'd been paying for, and the screen was replaced. Then renewal comes around. Officially, a windscreen claim should not affect your no-claims bonus in most cases, and most insurers say they do not count windscreen claims in their premium ratings. That is the official line. Here is what actually happens. When you go to compare and renew your policy, whether with your existing insurer or on a comparison site, you are required to declare any claims in the past 5 years, including windscreen claims. The moment that claim appears on your record, some insurers will price you differently, not because they classify it as a fault claim, but because they classify you statistically as a person who makes claims. And people who make claims cost more to insure. One driver declared a windscreen replacement on Compare the Market and watched their quote jump by £52 for a stone chip that was not their fault, on a road they could not avoid. The system prices the claim, not the cause. And it is worth saying plainly why this happens. It is not administrative error. It is structural. Insurers collect risk data on every interaction. A windscreen claim tells the model you are in a situation where the model had to pay out. The model adjusts. You pay more, even though you did nothing wrong, even though it was a lorry on the A14 that did everything wrong. The auto-renewal trap. The most expensive button you never pressed. Here is the mechanism that makes this entire system work. Auto-renewal. Your policy renews automatically unless you tell them to stop. That is the default. The default has been engineered deliberately to produce a specific outcome. You stay, you pay, and you never compare. The Financial Conduct Authority now requires insurers to include your previous year's premium in the renewal notice, so you can see exactly how much the price has changed. That rule was meant to be a transparency measure. What it has actually produced is a generation of drivers who see that their premium has gone up by £40, feel mildly irritated, and then auto-renew anyway because £40 does not feel like enough to make a phone call about. Here is what that £40 actually cost you. If your premium is £600 and you auto-renew without comparing, the data from over 1 million money supermarket quotes in late 2025 and early 2026 shows the average driver was paying £346 more than they needed to. £346, not 40, 346. That is not because the insurer charged them more than the rules allow. It is because a different insurer on the same comparison site would have charged them less. Different insurers have different appetites for different risk profiles. The insurer who was cheapest for you 12 months ago is very unlikely to be the cheapest for you today. The market shifts. Insurers change their target demographics. Their appetite for your postcode, your car group, your age changes month to month. The only way to capture that shift is to look. The auto-renewal default ensures most people never look. Before we get to the 3 rules that will save you money every year, I want to ask you something directly. Drop a comment right now. How long have you been with your current car insurer? 1 year? 3 years? More than 5? When did you last actually compare and switch? My prediction is that a significant number of you have been with the same insurer for more than 3 years. I am going to guess that a meaningful chunk of you have never switched at all. You renewed the first policy you ever bought and have been renewing it ever since. That is not loyalty. That is the product the industry designed you to become. It is worth saying that out loud. The 3 rules. These are the ones that change the number on your renewal. Rule 1. Never accept a renewal quote without running a comparison at least 21 days before your policy expires. This is not a rough guideline. It is backed by over 1 million real UK quotes. Money-saving experts' analysis found that the cheapest time to buy is from 21 to 26 days before renewal, with 25 days being the single cheapest day. The average policy on renewal day costs £723. Buy it 25 days earlier, and the average drops to £377. Insurers price based on urgency signals. A driver renewing at the last minute is statistically more likely to be disorganised, less likely to compare, and therefore a viable target for a higher price. A driver renewing 3.5 weeks early is statistically more likely to be a careful, low-risk customer. The algorithm rewards the early mover. Use that. Comparison sites, Compare the Market, Money Supermarket, Go Compare, and Confused. Do not use just one. The panels are not identical. A quote that does not appear on one site may be the cheapest on another. Spend 20 minutes. The data says that 20 minutes at the right time of year is worth £346. Rule 2. Call your existing insurer with the cheapest quote you have found and ask them to match it. This is the step most people skip. They find a cheaper quote elsewhere and simply switch, which is fine. But before you do, call your existing insurer with the number in front of you. Say the words, "I have a quote from a competitor for this amount of money for identical cover. Can you match it?" The answer is not always yes, but the answer is yes often enough that the call is always worth making. Insurance companies have retention budgets. They would rather keep you at a lower margin than lose you entirely. The customer who calls with a competitor quote is the customer they will discount. The customer who auto-renews is the customer they will price at market. Rule 3. Check your declared details before every renewal. Every single detail. Check your annual mileage. Check your job title. Check where the car is parked overnight. Check whether you are now commuting to a different location. Check whether your car has any modifications. The insurance industry discovered, and this is documented in multiple FCA studies, that more than 1 in 3 British drivers could be overpaying by more than £500 a year due to small inaccuracies and outdated information on their policy. Many of those cases are not fraud and not deliberate misrepresentation. It is simply information that has drifted away from accuracy because nobody updated it. Your mileage may have dropped because you work from home 3 days a week. Your job title may have changed, and a different title on a comparison site can produce a different premium. You might have moved the car from the street to a private driveway. Every one of these changes can move the number, and none of them require anything more than honesty and attention. Also, paying monthly for car insurance means paying interest. Go Compare's data shows that paying monthly adds between 8 and 11% to your total annual cost compared to paying up front. If your annual premium is £600, monthly payments cost you between £48 and £66 more over the year. That is not insurance. That is a loan at a rate your bank would be embarrassed to offer you. The buy it right maths, because the numbers are worth seeing clearly. Driver A, 42 years old, clean licence, no claims, Ford Focus, outer London postcode. Auto-renews every year without comparing. In 2023, their premium was £820. In 2024, it was £860. In 2025, it was £810. Over 3 years, they have paid £2,490. Driver B, same profile, same car, same postcode, spends 20 minutes on a comparison site 25 days before each renewal, calls their insurer with the best quote, pays annually. In 2023 they paid £540, in 2024 £510, in 2025 £490, over 3 years £1,540. Same driver, same car, same road, same risk, £950 apart over 3 years. Simply because one of them knew when to compare and one of them did not. That £950 is not a windfall from a smart investment. It is money that was taken from driver A and handed to an insurer because driver A let the default setting run. The default setting is not neutral. It is profitable for them. The bottom line. The car insurance market in the United Kingdom is not broken. It is working exactly as designed. It is designed to keep you paying more than you need to on a product you are legally required to buy, through a renewal process that defaults to inertia and rewards the drivers who push back. The Financial Conduct Authority ban on price walking in 2022 was a genuine intervention, but the industry adapted. The prices kept rising through 2023 and into 2024. And while premiums have now started to fall down around 9% in early 2026 compared to a year earlier, the average British driver is still paying significantly more than they would pay if they treated this like the negotiable annual bill it actually is. You're not stuck with the number on your renewal letter. That number is an opening position. It is what the insurer hopes you will accept without question, because statistically, most people do not be most people. Compare 25 days out, call to negotiate, pay annually. Check your details. That is the entire system. It takes less time than the queue at a drive-through. It saves more money than most people spend on a weekend away. If this video saved you from another year of overpaying, subscribe now and share it with every driver you know who is still letting their policy auto-renew without thinking. That is all.